Our chat says, hi, Robert Nosson. I'm an avid listener of your podcast. I've listened to various other podcasts for FIRE or Financial Independence Retire Early and other financial advice over the years, but I find your podcast my go-to for new things to learn and to understand new approaches to investing that you both recommend. My wife and I are in our mid-50s. We came to the United States as students with $600 and a suitcase. We got our master's degrees and have settled down here in our older age. Starting from scratch, we built up a liquid net worth, not including our house, of $4.5 million and a total net worth of $6.3 million when you include our home's equity. So here's our question. We live in a very high cost of living area, and we've lived in this house for over 10 years. The house is not quite what we would like, and we've embarked on a plan to demolish the house completely and build a new one in the exact same location as we really like the location. Now, estimates for rebuilding per our specs are $1.9 million. So when you add together our existing mortgage and this new money we'd have to spend, our new total post-construction mortgage would be $3.4 million. In 2025, we're expected to have a gross income of $1 million. It will probably go down a little bit in 2026 due to some of our RSUs vesting and not getting new ones, but my wife plans to retire in 7 years, and I plan to retire in another 10. I'm expecting our income to be about $800,000 or so combined until I retire in 10 years. Now, so far, we are healthy with some minor issues that occur with age. So our question is it a wise thing to do this at this point in our lives? And how long into retirement is it wise to carry a mortgage? Robert, you kick this one off.
Man, this is a tough cookie because on one side, I get it. You have a high net worth, you've done well for yourself, you're high earners, you want to have a nice house. But then if you're in your mid-50s now and you're looking to retire in the next 5 to 10 years, and let's say bulldozing the house and building the new one takes 18 months before you get settled in. So that's 2 years of the 10 years. You've got 8 years left that you want to really go at it and work. Do you really want to go into retirement with a $25,000 a month mortgage is the main question I have. To me, it sounds like a lot. I'd love to see it if you could take the existing house, maybe do a $300,000-$400,000 renovation, $500,000 renovation and make it what you want, or sell it as is and go buy something that's already done and ready so you can move into something that's more fitting for what you desire without putting yourself in harm's way with having this huge mortgage going into retirement. That's just me because things change. And, you don't know what could happen with the new house. You could run into issues where it takes longer and longer. So you're going to have to offset that with a place to live during the rebuild. So you're going to have those expenses on top of that. So I would really think long and hard of, do you want the freedom in retirement more than a heavy mortgage on the house payment?
I like that answer. I guess I'll answer their question here first and then kind of walk through where my head's at. So the first question that they asked, right, is like, how long into retirement is it wise to carry a mortgage? Well, assuming that you're not, like, retirement for most people assumes they're not earning income anymore and they're living off of their portfolio income of like that 4, 5, 6% every single year is different for everybody, but it's normally $80,000 to maybe $200,000 a year. So if you're making $80,000 to $200,000 a year pre-tax, let's call that $60,000 to $160,000 a year post-tax, having a mortgage that would take away $20,000, $30,000, $40,000, $50,000 of that every year is not a good idea, which is why I'm a firm believer that people should pay off their mortgage before they're 65, before they want to retire, and they can just own their house and make money or live off the money they have, whatever. So I don't think people should retire with mortgages. So let's dig into some numbers here, Robert. They said that their current homes, they have a $6.3 million net worth, including the home, 4.5 without it, which means, the equity there is $1.8 million. And they want to spend $1.9 million to build out this new home. And they have a $1.5 million mortgage right now on their home. And they want to spend another 1.9 building it out, which gets them to that 3.4. I guess I'm just worried about, right, is like, what happens to this 1.8 million in equity of the house? Does it just disappear? Are you hoping that this new home is worth?
Well, you'd have to take 3.4 and you'd have to add the equity loss, the potential equity loss, to come up with what the value of the new home would be, the perceived value based on comps,
right,
to figure out where that goes.
Million. And so it's like, do you think that this new home that you're going to build is worth 5.2 million? Are there other $4, $5, $6, $7 million homes in your neighborhood? Like, is that a real thing? And by reading this, your home right now is worth about 3. So you're saying that you could like tear it down and build a new one, and this new one's going to be worth 5.5. Like, that's what I'd be worried about, is like getting rid of this $1.8 million of equity in your home. The math doesn't math for me unless you can keep that equity somehow, some way, and you can prove that that equity is going to remain there. And then, golly, like, I don't know what y'all are going to do with a $25,000 a month mortgage. Like, that's crazy. That's crazy. You guys obviously have the money to pay it off if you wanted to, but that wouldn't really leave you that much in your investment accounts. Well, I guess maybe once they double in like 10 years or so. So maybe you could, right? Maybe you could keep this $4.5 million invested in the markets. It doubles to 9, and then use 3-ish million, I'm sure would still be the balance on the mortgage in 10 years. So you'd have a paid for house and $6 million of investments. That's like the best case scenario. But I mean, that is assuming a lot of stuff here.
Well, let's do some more assumptions, though. If we want them to follow the 4% rule, which is what we believe everyone should seek in retirement, to be able to cover just the house payment and let's say HOA or taxes and insurance, they're going to be somewhere $26,000, $27,000, $28,000. So you would need over $8 million in investable retirement capital, not including any equity in a house, to be able to stick to that 4% rule just to pay the minimums on this house. So they would have to get to $8 million plus in the next 8 or 10 years to be able to make that work. To me, the math just doesn't math. I personally wouldn't do it.
Yeah, $8 million just to live in the house. Like, that's not, you mentioned you're in a very high cost of living area. Like, that's not groceries. That doesn't include transportation. That doesn't include eating out and actually enjoying your retirement. If it were me and I were in your shoes, I would say, okay, great. I'm taking $300,000, $500,000, because that's only 3 or 4 or 5, 6 months of you working, because you guys make $1 million a year. I would take a lot of money and I would redo the house that I'm in right now. I want the perfect kitchen. I want the redone backyard. I want to have a cool pool, whatever you want to make it more you and feels better to you because you like this location. But I don't think I'd demo the house, build a new one, take on $3.5 million of debt. It just doesn't make sense.
Got it. I agree.